Hey there, financial enthusiasts and gold watchers. It's your favorite market analyst, Iggy, from Investing Iguana. Remember about 6 months ago when I advised taking a closer look at investing in gold? Well, today, we're revisiting that golden advice as it turns out to be more relevant than ever. We're diving into the red-hot topic of why gold prices are skyrocketing in Asia, a deep dive into the economic signals. Gold prices have surged to near 7-month highs in the Asian markets, validating our previous analysis and showcasing the importance of staying ahead in the financial game. In fact, about 6 months ago, I created a few videos about investing in gold. With a proven track record in identifying market trends, I'm here to delve deeper into the dovish signals from the Federal Reserve and their ripple effect across the Asian gold market. We'll dissect the impact of the falling dollar and the retreat of U.S. Treasury yields and how they're fueling this surge in gold prices. Plus, we'll analyze the role of anticipated key economic reports from the U.S. and China in this context. So, fasten your seatbelts, we're about to embark on a journey that not only vindicates our past predictions, but also offers fresh insights into the ever-dynamic world of gold. In the dynamic world of Asian trade, gold prices soared to a near 7-month apex on Wednesday, fueled by a cascade of dovish signals from Federal Reserve officials. This development has stirred up anticipation of an early policy shift by the central bank, capturing the attention of investors in Singapore and beyond. The U.S. dollar's retreat to near 4-month lows has been a boon for gold, bolstering its allure. Simultaneously, a decline in U.S. Treasury yields, with the 10-year rate dipping to a 2-month low in Asian trade, further bolstered the yellow metal's appeal. Amidst this financial landscape, there's a palpable sense of caution as investors await a series of pivotal economic reports due this week from the U.S. and China. This anticipation has heightened the demand for gold as a safe haven, particularly in light of several lackluster economic indicators from Japan and the Eurozone, which have stoked concerns over a looming global economic slowdown. Spot gold witnessed a modest uptick of 0.1%, reaching $2,044.08 an ounce, while gold futures set for December edged up 0.2% to $2,044.20 an ounce by 23:27 Eastern Time, 4:37 Greenwich Mean Time. Notably, spot prices are now merely about $30 shy of the record high seen earlier this year. Fed officials, in their latest remarks, have hinted at a more prudent approach in maintaining higher interest rates, with easing inflation potentially leading to an earlier-than-anticipated policy relaxation. Fed Governor Christopher Waller, a known hawk, acknowledged that the high rates implemented this year have sufficiently curtailed inflation, suggesting that a continued decline in price pressures might prompt the Fed to start reducing interest rates. These comments have led traders to speculate a significant chance, at least 40%, that the Fed could slash rates by March 2024 and possibly maintain current rates in December. This week is crucial for further insights from Waller and other Fed officials as it precedes the blackout period ahead of the Fed's mid-December meeting. Chairman Jerome Powell is also slated to speak later in the week. The shift in the Fed's hawkish stance has been a tailwind for gold throughout November, positioning the metal for an over 3% gain for the month. Any potential rate cuts by the Fed could favor the gold market, as higher rates typically increase the opportunity cost of investing in gold. Tony Sycamore, an analyst at Iggy Markets, described the scenario as a perfect environment for gold in a discussion with Osbiz. Meanwhile, in the realm of industrial metals, copper prices held steady on Wednesday. Supply disruptions in Peru and Panama have calmed some nerves ahead of crucial Chinese economic data this week. Copper futures for March remained unchanged at $3.8460 a pound after rallying 1.5% earlier in the week. The dollar's weakness also contributed to copper's stability. In Panama, a copper mine operated by Canadian firm First Quantum was ordered to cease operations by the government, citing constitutional issues with its contract. This development coincided with a planned strike at MMG Ltd's Los Bambos copper mine in Peru, signaling potential tightness in copper markets in the coming months, a factor that could underpin copper prices. However, the market is still on tenterhooks ahead of key purchasing managers' index data from China, which is expected to reveal a continued slump in manufacturing activity in the world's top copper importer. First off, let's set the scene. We've witnessed gold prices soaring to near 7-month highs recently, largely influenced by a series of dovish signals from Federal Reserve officials. This trend has ignited speculation about an early pivot by the central bank, a factor that could significantly impact gold prices in 2024. 1. The Fed's policy and its implications. As we look ahead to 2024, the approach of the Federal Reserve to interest rates will indeed be a key driver for gold prices. If the Federal Reserve adopts a more cautious stance and eases up on interest rates, as current trends suggest, this could potentially bode well for gold. Lower interest rates tend to weaken the dollar, making gold more attractive as an investment. This is because gold is priced in dollars, and when the value of the dollar decreases against other currencies, it becomes cheaper for investors to buy gold. As a result, demand for gold increases, driving up its price. Furthermore, in a low-interest rate environment, the opportunity cost of holding gold, which does not offer a yield, decreases. This makes gold more attractive compared to yield-bearing assets like bonds. However, it's important to note that the relationship between interest rates and gold prices is complex and influenced by a multitude of factors. These include inflation expectations, geopolitical tensions, and overall market sentiment. Therefore, while the Federal Reserve's approach to interest rates will undoubtedly play a significant role, it's just one piece of the puzzle. 2. Economic indicators and safe haven demand. The anticipation and subsequent release of key economic data from major economies like the US and China will indeed play a crucial role in influencing gold prices in 2024. These data points, which include indicators such as GDP growth rates, unemployment rates, and consumer confidence indices, provide valuable insights into the health of these economies. If these indicators point to an economic slowdown or increased uncertainty, it could trigger a surge in safe haven demand for gold. Investors often turn to gold as a hedge against economic instability, as it is seen as a store of value that can retain its worth during turbulent times. This is particularly true in times of economic uncertainty or when traditional investments such as stocks and bonds are performing poorly. In the context of 2024, given the current global economic climate, there is a possibility that we could see increased volatility and uncertainty. Factors such as ongoing trade tensions, geopolitical risks, and the potential for economic slowdowns in major economies could contribute to this uncertainty. If these factors materialize, they could drive investors towards safe haven assets like gold, leading to an increase in its price. However, it's important to note that the relationship between economic indicators and gold prices is complex and influenced by a multitude of factors. Therefore, while the release of key economic data can provide some indication of potential trends, predicting the future price of gold with certainty remains a challenging task. 3. Global economic slowdown and market sentiment. Indeed, weak economic readings from regions like Japan and the Eurozone are already fueling concerns over a potential global economic slowdown. If this trend continues or intensifies in 2024, it could further fuel investor appetite for gold. A global economic downturn often leads to a flight to safety, with investors seeking refuge in assets that are perceived to be less risky or more stable. Gold, with its reputation as a safe haven asset, is often one of the primary beneficiaries of this shift in investor sentiment. In times of economic uncertainty, gold is seen as a store of value that can retain its worth, even when other assets are declining in value. This makes it an attractive investment option for those looking to protect their wealth during turbulent times. However, it's important to note that while gold can provide a hedge against economic instability, it is not immune to volatility. The price of gold can fluctuate based on a variety of factors, including changes in supply and demand, inflation rates, and geopolitical events. Therefore, while the ongoing economic challenges in regions like Japan and the Eurozone could potentially boost demand for gold in 2024, the exact impact will depend on a multitude of factors. Investors will need to closely monitor these developments and make informed decisions based on their individual risk tolerance and investment goals. 4. The dollar's trajectory. The performance of the dollar is intrinsically linked to gold prices. A weakening dollar, which we've seen recently, typically enhances the appeal of gold as an investment. This is because gold is priced in dollars on the international market, so when the dollar weakens, it effectively makes gold cheaper for investors holding other currencies, thereby increasing demand for gold. If the dollar continues to soften in 2024, this could provide additional upward momentum for gold prices. A weaker dollar could make gold more attractive to international investors, potentially leading to increased demand and higher prices. However, it's important to note that the relationship between the dollar and gold prices is complex and influenced by a multitude of factors. These include interest rates, inflation expectations, geopolitical events, and overall market sentiment. Therefore, while a weakening dollar could potentially boost gold prices, the exact impact will depend on these and other factors. 5. Technological and industrial demand. Besides macroeconomic factors, technological and industrial demand for gold is another crucial aspect to consider. Advancements in technology and increases in industrial applications could indeed spur demand for gold, influencing its price. Gold is not just a precious metal used in jewelry or as a safe haven investment, it also has significant industrial applications. It is highly valued in the electronics industry due to its excellent conductivity and resistance to corrosion. Gold is used in the manufacturing of various electronic devices, including computers, smartphones, and other high-tech equipment. In addition, gold is also used in other industries such as dentistry and aerospace, further driving its demand. For instance, gold is used in the aerospace industry for its reliability and excellent conductivity, especially in critical, high-reliability applications. As technology continues to advance, new uses for gold may be discovered, potentially increasing its demand. For example, the ongoing development of green technologies, such as photovoltaic cells for solar energy, could lead to increased demand for gold. Therefore, keeping an eye on technological advancements and trends in industrial demand for gold could provide valuable insights into potential shifts in gold prices. If these sectors continue to grow and innovate, and if gold continues to play a crucial role in these industries, it could provide additional upward momentum for gold prices in 2024 and beyond. And there you have it, folks, an in-depth exploration of the soaring gold prices in Asia and the economic forces at play. From analyzing the impact of Federal Reserve policies to understanding global market dynamics, we've covered the gamut of factors contributing to this exciting trend in the gold market. Remember, in the world of investing, keeping an eye on such indicators is crucial for making informed decisions. As your guide in the intricate world of finance, I'm committed to bringing you the insights and analysis that matter. This is Iggy from Investing Iguana, signing off. Stay curious, keep analyzing, and I'll catch you in the next video, where we'll continue to navigate the fascinating world of finance.